A lot is happening right now that could affect people on government support, and most of it is starting quietly. Some changes have already begun, some are coming in just a few days, and others have deadlines that are getting closer every week. In this video, I'm going to break everything down in very simple terms. No complicated language, no confusion, just what is changing, why it matters, and what you may need to do before time runs out. Because the truth is, these updates are not always clearly explained to the public. Many people only find out when it's already too late to take action. So staying informed right now really matters. Let's start with the first big change, and it's already in motion. A government benefits agency has introduced stronger rules to recover money from people who owe old benefit debts. This change began recently, and letters are now being sent out to thousands of people across the country. These letters are important. They are not just reminders. They are warnings that action may be taken if nothing is done. Here's what's new in simple terms. If someone has been overpaid benefits in the past and has not paid the money back, the government can now take repayment directly from their bank account in certain cases. This means they may not need to go through a court first to recover the money. This mainly applies to people who are no longer receiving benefits, but still have unpaid balances from earlier overpayments. There is also another serious part of this update. In some situations where the debt is large and the person does not respond or make arrangements, further action can be taken through the courts. In the most serious cases, this could even include restricting a person's driving license. However, this step is not automatic. It is generally aimed at larger debts and people who completely ignore contact attempts. There are also protections in place, especially if someone depends on driving for work or carrying responsibilities. Now, there is an important point here that many people miss. This is not an immediate punishment system. There is a time window before stronger actions begin. Right now, that window is open. If someone receives one of these letters, they usually have several months to respond, contact the agency, and set up a payment plan that they can afford. In most cases, taking action early prevents things from escalating further. The key message from the agency is simple. These stronger recovery powers can often be avoided completely if the person responds and communicates in time. So if you or someone you know receives one of these letters, ignoring it is the worst option. The better step is to open it, read it carefully, and respond as soon as possible. If there is any disagreement about the amount owed, there is also a formal way to challenge it and ask for a review. And for anyone who feels overwhelmed or unsure what to do, free support services exist that can help explain the situation and guide the next steps. The important thing right now is awareness and timing, because once the enforcement stage begins later in the year, options may become more limited. Now, in the next part, there's another major change coming that affects everyday household costs, and it starts very soon. The next change affects almost every household in the country, especially people who are not on a fixed energy deal. Starting from the 1st of July 2026, energy prices are going up again under the official price cap set by the regulator. This cap is the maximum amount most households can be charged for gas and electricity on a standard tariff. And this time, the increase is noticeable. For a typical household, the yearly cost goes up by a few £100s. On average, it works out to around an extra £15 to £20 per month, depending on usage and region. The main reason for this rise is the higher cost of gas on the global market. When wholesale energy prices increase, it eventually feeds into what people pay at home. And recently, gas prices have gone up quite sharply due to global supply pressures. But here's the part many people don't realize, and it can cause problems if it's ignored. When the price cap changes, your energy supplier updates your rates automatically. However, your monthly direct debit does not always adjust at the same time. In some cases, companies update it straight away, but in other cases, they delay the change or spread it out over time. That can make it look like nothing has changed on the surface. The problem is your real usage cost is still higher. This can quietly create a balance on your account without you noticing. In simple terms, you could slowly start owing money without realizing it, even if you are paying every month like normal. That's why it's important to check your account this week, not later. Log into your energy account or contact your supplier and ask a couple of simple questions. First, ask what your current monthly direct debit is set at. Second, ask whether it has been updated to reflect the new July price changes. This quick check can help you avoid an unexpected bill later on. There's another point worth considering as well. If you are currently on a standard variable tariff, this is often the time when suppliers also start offering new fixed-rate deals. After a price cap increase, companies usually release fixed plans to attract customers who want more stability. For some households, locking in a fixed rate now may help avoid further increases later in the year, but it depends on the offer and your usage, so it's worth comparing carefully before making any decision. The main idea here is simple. Don't assume your direct debit will automatically keep you up to date with rising costs. A quick check now can prevent a larger surprise later. Next, there's another change coming on the same date that affects a very different group of people, and it could have a direct impact on vehicle costs for many disabled users. The next update affects people who use the Motability Scheme in the UK. This scheme helps people who receive disability support payments lease a car, scooter, or powered wheelchair using their mobility allowance. For many, it is an important way to stay independent and travel more easily. From the 1st of July 2026, there is a key change in how certain lease payments are handled. Until now, if someone chose a vehicle that cost more than their standard allowance, they could pay a small extra monthly amount known as a top-up. That extra payment used to be free from VAT, meaning no extra tax was added, but this is changing. From July 1st, new Motability leases will no longer have that VAT exemption on top-up payments. This means VAT will now be added at the standard rate, which increases the overall cost. On top of that, insurance-related tax will also apply to new agreements starting from the same date. It is important to be clear about one thing. Existing users are not affected. If you already have a vehicle under the scheme, your current contract stays the same. Nothing changes for you until your agreement ends. The change only applies to new leases started after the 1st of July. But for people planning to get a new vehicle this summer, the timing really matters. Here is a simple example. If someone was paying an extra £100 per month as a top-up under the old rules, it stayed £100. Under the new rules, that same £100 becomes £120 after VAT is added. Over a full year, that difference adds up, and over a 3-year lease, it becomes a significant extra cost. So the same vehicle choice can become noticeably more expensive depending on when the agreement is signed. That is why anyone considering a new Motability vehicle is being advised to check timing carefully. In some cases, arranging a lease before the 1st of July could mean avoiding these extra charges altogether. A quick conversation with a Motability dealer could make a real difference here, especially if a change of vehicle was already being planned. Now, the next change is not about prices or schemes. It's about money many people are entitled to but have not yet claimed, and timing is critical. This next part is not about a new charge or a rule change. It's about money that already exists, but many people are not receiving it even though they qualify. It relates to pension credit. Pension credit is extra support for people on a low retirement income. It can increase weekly income, and it also opens the door to other benefits that many people don't realize they could get. Here's the key point right now. Pension credit can only be backdated for a limited time, usually up to 3 months. That means if someone applies late, they don't just miss future payments. They can also permanently lose money they would have already received. And this is where timing becomes very important. We are now partway through the financial year. The new rates for 2026-27 started in April. So every week that passes, the amount that could be claimed from earlier in the year becomes smaller. To put it simply, the longer someone waits, the more money disappears forever. For a single person, pension credit can be worth over £200 per week. For couples, it can be over £350 per week. That is a significant difference for anyone on a tight budget. But the impact goes beyond the weekly payment. Getting pension credit can also unlock other forms of support, such as help with council tax, assistance with heating costs during winter, and additional seasonal payments that are only available to people who qualify. In many cases, these extra supports can add up to hundreds of pounds in savings each year. However, there is a catch. Some of these winter-related benefits depend on being eligible at a specific time of year. If someone applies too late, they may miss out on those payments entirely, even if they qualify later. That's why waiting can cost more than people expect. Right now, there are still pensioners who qualify but have not made a claim. In fact, a large number of eligible people are not receiving pension credit at all, simply because they have never applied or assumed they would not qualify. If someone's weekly income is below the threshold, it is usually worth checking eligibility rather than guessing. A simple phone call can start the process, and in many cases, claims can be backdated if they are made in time. The important message is this. This is not just about monthly income. It's about making sure no entitlement is left unclaimed while the window is still open. Next, there is one final area to look at, and it involves state pension payments and what many people should check this month to avoid surprises. The final update is about the state pension, and this is something every pensioner should double-check this month to avoid unexpected shortfalls. State pension payments are made every 4 weeks, and the exact payment day depends on your national insurance number. That schedule does not change in July 2026, so payments will still arrive on their normal dates. But even when payments arrive on time, the amount can sometimes be different from what people expect. Earlier in the year, the state pension increased under the triple lock system. That means payments went up in April based on inflation, wages, or a set minimum increases, whichever was highest. The current full new state pension is just over £240 per week. but not everyone receives this full amount. One of the most common reasons for a lower payment is gaps in national insurance records. To receive the full state pension, most people need around 35 qualifying years of contributions. If there are missing years, the weekly amount can be reduced. Sometimes these gaps happen even when people were working, especially if records were not updated correctly or if employment details were not fully recorded. That is why it is important to check your national insurance record online through your government tax account. If you spot missing years that you believe should be included, you can contact HMRC and ask for a review. In some cases, records can be corrected if evidence is provided. There is another thing to be aware of as well. Some pensioners may receive letters from HMRC about tax on pension income. These are called simple assessment letters. They are not unusual, but they should not be ignored. If the information in the letter looks incorrect, it can be questioned. But there are strict deadlines for responding or challenging it, so it should be dealt with promptly. The main point here is simple. Even when payments look automatic, they are still based on your personal record. If that record is incomplete or wrong, your income may not be what you expect. So it is worth taking a few minutes to check everything is correct rather than assuming it is. And when we put everything together, the message is clear. There are new recovery powers starting to be enforced soon. Energy costs are rising again from July. Motability costs are changing for new leases. Pension credit backdating is slowly reducing week by week. And state pension amounts depend on checking your record carefully. None of these changes are hidden, but they are easy to miss if you are not looking for them. That's why staying informed right now really matters.